Well, good afternoon to our CLA family members, clients, community partners, and friends. Welcome back to Livestream. We sincerely hope that all of you are remaining safe and healthy at this time. Today, we have a special guest with us from our National Tax Office, my friend and colleague, Chris Hesse. Chris is someone who I turn to for a deep dive into technical questions, for perspective on the practical application of the code, and for what we'll do today, which is to separate fact from fiction when we have so much happening in Congress. I'm a huge fan of Chris Hesse, so I'm really excited to have him here, especially when there's a lot of fear that we have surrounding any of the changes that we're seeing. And we've seen so much change lately. It's so great to have Chris and his team with us to work through all of the rumors and realities. So welcome, Chris. Happy to have you today.
Oh, thanks for inviting me, Jen. I'm looking forward to it.
Yeah, it's going to be a great session. So before we get started, we're going to quickly review our housekeeping items. As you know, we have activated live Q&A so that we can interact with you during the show. If you're registered, you may add your questions and also like the questions of others to move them up in priority and have them answered during our time together. I'd like to urge you to subscribe to our YouTube channel and hit that like button on the live stream so that you can get easy reminders and notifications about our future sessions. We'd also like to make you aware of some of our upcoming events. And then on November 17th, we'll have a follow-up session on year-end planning, which should be fantastic. The other thing that we want you to stay tuned to, because it's actually going to be a factor in some legislation coming up, but we've got the IT webinar series and its considerations for financial institutions, September 21st. Again, you can tune in and evaluate your technology vendor contracts and get some information about that. And then again, on November 23rd, we have a session. So please visit our events page on CLAconnect.com to register and find any relevant events for you and your organizations. Of course, finally, please continue to engage with your advisors here at CLA. We're always sharing articles and white papers with you, and we're looking forward to interacting with you when you hit that Contact Us button and send your questions directly through our webpage. But let's get down to business with Chris. Earlier this week, the House Ways and Means Committee released hundreds of pages of draft legislative text under budget reconciliation instructions, including the potential pay-for provisions. Although it is still early in the legislative process, the proposals provide us with a much clearer picture of the changes that the committee is considering. The revenue-raising provisions include corporate and international tax reform, IRS funding and compliance, increased taxes on higher income individuals, and various other provisions, including a modification of wash sale and disguise sale rules, a 5-year limit on disallowed business interest expense carry forwards, and the repeal of Section 1202 for certain taxpayers. Chris, there is a lot in this and a lot that we're watching. Today, what I want to do is just take the time with you to unpack some of the key areas while keeping a lens focused on the reality rather than some of the rumors that we're hearing. We also want to understand what all this means from a tax planning perspective. So before we dive into the details, can you start by telling us what's happening now and where things stand with the legislation?
Well, Jen, the last 18 months have been such a roller coaster of tax law changes as Congress has meddled with the Internal Revenue Code to address the pandemic issues. We've had a presidential election in the middle of this, and President Biden and the new Congress are proposing changes to what was done 4 years ago by the previous administration in Congress. Not only are they proposing to roll back some of those provisions, but remember, only for those with income over $400,000, their concept is to go in the opposite direction, to substantially raise taxes on investment and business income, and especially for the business income for the very high wealthy, high income individuals. So Ways and Means has approved its reconciliation bill on a near party line vote. There was one Democrat that voted no. The Senate doesn't yet have a bill. It has several proposals from Senator Wyden, who's the chair of the Senate Finance Committee, and some of those proposals differ substantially from the Ways and Means approach. The House probably won't vote on the reconciliation bill until there's a Senate bill and until the Senate has voted, whatever that might look like. And because the Senate is split 50-50, the House isn't willing to take the leap until the Senate gets its business done. And then the majority party in the House can lose just only 3 votes and still pass its legislation. So both of these approaches, though, differ from President Biden's proposals.
Well, Chris, I think that's helpful perspective to know that there's really nothing final out there as we're talking this through. And so really appreciate how much things are really changing even now, right, as we meet today, and they have been this week as we've been talking things through, even since we started pulling together our questions for our session. But that said, there are some things that people need to be looking at to understand what could happen. And so what I'd like to do is take them in chunks and start with the corporate tax rate. So can you tell me about the proposed changes there?
So the President Biden would like to move that corporate rate to 28%, and the House proposal that's out there that they passed, this legislation, actually has 3 rates. We're going to go back to a graduated income tax rate for the corporations if this makes it into the final legislation. We've got to always remember everything that I'm saying is caveated if this makes it into the final legislation. So they move the rate to 26.5%, but that would only be for the very large C corporations, those with more than $5 million proposed of taxable income. Other C corporations, those below 5 million, would be at 21%. And the smallest ones, I say small, but those with taxable income no more than $400,000 would actually have a tax cut down to 18%. That's still a little bit more than what it used to be before the Tax Cuts and Jobs Act, but 18, 21, 26.5. Those are your 3 rates.
Well, and that's so interesting, right? Because a graduated rate would change the game for so many businesses. So that'll be really something to watch and see what happens, especially from an administrative perspective. Now, similarly to the corporate tax rate, we do have a lot of questions coming in from our clients and CLA family members about what's proposed for the individual rates. Do you mind diving into that with me too?
Yeah, individuals. Now, remember, most things stay the same in the individual rate bracket structure. What's changing, though, what's proposed to change, and I'm sure it's going to happen, is the moving of that 37% rate. That's a top marginal rate from 37% to 39.6%. But the House here has another approach and taking and adding yet another. It's really another bracket, but they call it a surcharge, a 3% surcharge based on your income above $5 million. And when I say income, it's the adjusted gross income above $5 million. So the individual who has very high income, but also a very high amount of charitable contributions, won't get the benefit of the charitable deduction against that 3% rate. In other words, it's the surcharge is on the income of adjusted gross income, not on taxable income. So in effect, you're going to see a 42.6% tax rate, but even more than that because you don't get the benefits of these charitable contributions. So go ahead.
No, that's really interesting. You and I could probably go offline and have a conversation about that. The impact it has on charitable giving, but we'll probably pass on that for right now. Yeah. One question I do have that related to all of this, and because it does keep coming up in a lot of conversations, is if that passes, what year would it be effective? Would it be 2021 because it's happening this year? Could do you know? I know, and interestingly enough, I know a lot of these provisions have different effective years. So
you're right. These provisions do have different effective dates, and this one, the rate bracket structure, for the individuals is for years beginning after 2021. So calendar 2022. The corporate rate, they really don't tell us. It says for years beginning after 2021. We usually, when the corporation bracket tax structure changes, they phase that in, or for the fiscal year C corporations, they have a split bracket structure as they phase that in. But nearly all individuals are calendar year, so just say it's going to be effective next year, 2022.
That makes sense and gives people a little bit of time to plan if everything comes through, but we'll see. Yeah. So another big topic that we want to address today, at least, is the pay-fors, right? And it's the increase in capital gains rate and the effective date of that change. So within the pay-fors, we've talked about corporate tax rate, we've talked about individual tax rates. Now, what do we see proposed for the capital gains rate?
Capital gains, it's been a big topic of concern. Because President Biden was saying, well, high income individuals over $1 million, we're going to run that up and charge long-term capital gains at the same rate as ordinary, which same rate as ordinary is 39.6 plus the 3.8% net investment income tax, big numbers. Well, the House wasn't willing to go that far. And I think this is just me, but I think that there's some recognition, there's some economists out there that are saying, well, where's the revenue raising maximum potential for capital gains? And there's some opinion out there that it's 28%. You go over 28%, and then you actually start losing capital gain tax revenue because people, rather than selling their assets, they'll just hold on to them. So if you get above 28%, and that's what we're seeing here is a movement from the 20% capital gain rate that we have today to instead be a 25% capital gain rate. And you say, well, that's not 28. Well, yeah, but add the 3.8% net investment income tax to that. We'll talk about that in a little bit. But you'll also ask me about the effective date here. And it says effective date for 2021, but it's not really. Because what they're proposing here is for transactions that occurred before, gains recognized before September 13th would be at the old rate, 20%. Gains recognized September 13th and later would be at the 25% rate. So there's an effective date for the 2021 year. We are going to have to identify the specific date on which this transaction occurred. Installment sales, for example, that were in prior years, they should have the 20% rate for all of 21, but for 2022, it looks like they would go to that 25% maximum rate as well. And while we're talking about capital gains, I just want to put a word out for Section 1202. That's that provision for qualified small business stock. And as you know, Jen, it has a 5-year holding period, and it has to be originally issued stock to me. I have to get that stock in the original issuance from the corporation. Now, for sales after September 12th, they won't qualify for the 75% or the 100% capital gain exclusion. They would only qualify for a 50% capital gain exclusion for people who have an adjusted gross income greater than $400,000. Now, to me, that breaks a promise that the government said, invest in these stocks, high-tech companies, startup companies, et cetera. And if it's successful, you won't be taxed on the gain of that stock if you've held it for 5 years and you qualify for this 100% capital gain exclusion. And now it's like a bait and switch that, we're going to change the rules in the middle of the game. Sorry, you're going to have some capital gains tax to pay anyway.
Yeah, it's amazing. I mean, there's so much packed into, so many follow-ups, right, packed into what you just said, how different rates and the taxation controls investor behavior and I mean really organizational behavior too. So that kind of being looked at with also, you know, how do we administer based on sort of the sliding dates and what's going on there, and then to your point, we do let legislation drive behavior and then we change the rules, you know, as you said, it is this binding contract exception and it's weird, right, that happens. But the other thing that you mentioned when you were talking was, you know, let's take a look at what's proposed for the net investment income tax too, as just a follow on to what's happening with capital gains tax. So could you maybe explain that and then talk about the proposed expansion of this tax?
Yeah, so a word on net investment income tax, that's that 3.8% additional tax on investment income and passive income, just passive, could be business income, but it's passive business income, and including if you sell assets, passive assets or investment gains. And it's only for people who have income above a specific threshold. But they're going to expand that. This is proposed for expansion, that if your taxable income is above $500,000 for a married filing joint, or $400,000 for other filing statuses, that it would include this 3.8% would be assessed on all of your business income, not just passive, but all of your business income and all business gains, regardless of the amount of it's whether you're passive or not passive. So let's just recap as to what this all means. That I have an effective rate on the income tax at 39.6, and I add 3.8% net investment income tax. And then for the very wealthy, this surcharge is going to hit if you're above $5 million at 3%. That means that you'll have a federal top tax bracket in effect of 46.4%. And that's before any state income tax, of course. Now, the other odd part about this, and this is just another indication of marriage penalty, that a married couple that are both earning money, business income, higher income, both of them, they would be better off, considerably better off as two single individuals. A little bit of disincentive to get married and have a nuclear family, if you will, because of the tax structure that we have. It's just an odd system that, and incentives and disincentives that we have here.
It really is. You know, when you talk about taxes driving behavior, you know, there are a lot of values that we think that are being designed to be reinforced, and then there's some like this. When you look at it through this lens, to your point, it's, you know, it gives different reasons or different support for a marriage penalty, or, you know, any number of things. So there's, as you said, so much being looked at right now, and that net investment income taxes could also be a game changer for a lot of people. So what I'd like to do now is pivot and talk a little bit about the 199 Cafe deduction. I know a lot of people are asking us about, you know, the step up in basis question. We'll get there as well as part of our discussion. But first, I want to bring some of our audience up to speed on the 199 Cafe, about what it is, and then talk about the proposed limitation that's also written into this plan.
Yes, trying to not talk tax code ease and being a tax code nerd, but 199 Cap A, that's the provision for the qualified business income, the 20% deduction that taxpayers have for their sole proprietorship or their investment in a business partnership or business S corporation. And as a 20% deduction, I call it a free deduction. If you have this, you don't have to spend money for it. You just get 20% reduction off of your taxable income. It effectively lowers that maximum tax rate from 37% to 29.6%. There's some special rules on specified service trades or businesses where their deduction is phased out as their income exceeds $330,000 married filing joint. But effectively, the Ways and Means Committee proposal here is to put a cap on the amount of the deduction, that the maximum deduction would be capped at about $5 million of business income. The maximum deduction would be, I said 5 million, that's not right. The maximum deduction would be $500,000. Now that would take into effect when you're at $2.5 million of business income. So now get to that $5 million. For that person who's subject to the 3% surcharge, you're dealing with a rate increase from 29.6 because active business income was not subject to the net investment income tax. You're going from 29.6% to 46.4%, or a 16.8 percentage point increase in your tax rate. Now, Ways and Means. I said the deduction maxes out at $500,000. That's the equivalent of $2.5 million of business income. For a trust or estate, maximum deduction, $10,000. Once you're above $50,000 of business income in that estate or trust, you're maxed out. So it's going to be hitting the trusts and estates that much more. Now, Senator Wyden had a different approach entirely. He would just phase out the deduction entirely for anybody with income greater than $400,000. There'd be a $100,000 phase out range between $400,000 and $500,000. And then you'd be at zero. So he'd be a lot tougher on the business community by eliminating the 20% deduction if you had income greater than $500,000, but he'd expand the deduction a little bit for the specified service trades or businesses. Also, just another, his proposal would have a significant, again, another significant marriage penalty.
Interesting. And I think that's going to be one to watch to see what happens with that, because it doesn't seem like there's as much of a clear path as far as which way the proposals are going to look. So one of the things, and again, we've been getting questions about it in the chat as we've been presenting on these various pieces, and you and I even talked about this yesterday over email about the estate tax and the proposed end to the step up in basis. Can you share for everyone what we're seeing and thinking about the likelihood that this will pass?
Yeah, I don't think, although it was very much proposed by President Biden, also Senator Wyden, Senator Sanders, there's a group of senators and representatives that want to get rid of the step up in basis. At death, of course, you restart the tax basis of assets. The heirs receive those assets at now fair market value for the most part. There's special rules, of course. There's always special rules. But the Ways and Means Committee, they would continue on with step up in basis. Really, the only thing that changes in the Ways and Means Committee's proposal is to accelerate the time when this estate tax deduction exemption that we have, call it $12 million right now. If I died today, my estate's less than $12 million, there's no estate tax. At the end of 2025, that's scheduled to be cut in half, go back to about a $6 million exemption number. Well, they would move that. The Ways and Means Committee proposal is to accelerate that cutting in half to where deaths after 2021 or gifts made after 2021 would have an exemption of the $6 million. Now, no change in rate. That was also somewhat of a surprise. I kind of expected an increase in the estate and gift tax rate, but no change there. It stays at about 40%. There's some changes in grantor trust taxation that are being proposed. Now, this grantor trust, I put property into a trust. If I'm in control or have enough control or enough benefits associated with that trust, I'm still taxed on it. that means that it's called a grantor trust. And for the what the Ways and Means Committee proposal is to treat the transfers to the grantor trusts as still subject to the estate tax. Now, there's this narrow group of trusts that are taxed to the grantor, the person who put the property into the trust for income tax purposes, but they're treated as outside of your estate for estate tax purposes, because when you put the property into the trust, it's treated as a taxable gift. And so a lot of people do is they'll fund these trusts with maybe the maximum $12 million of estate tax exemption, no immediate tax because that was a taxable gift, and no lifetime transfers of up to $12 million exempt. And then it's outside of their estate. That's called, one of the versions of that is an intentionally defective grantor trust. It's a great estate planning opportunity. Well, that would go away under this proposal. Just a short answer to it, that it would go away, but effective for transfers into trusts and grantor trusts formed after 2021. So here we have an opportunity, remaining 3.5 months of the year, for people who haven't done their estate planning yet and would be subject to the estate tax, better get together with the CLA wealth advisor and the gift and estate planning group to do that planning, see if you want to be taking advantage of some of these proposals. Now, step up in basis, people ask, it looks like it's continuing on. The repeal of the step up in basis looks like it's dead. And the chair of the Ways and Means Committee said there's just not the votes in the House to pass that, and the various commentators all agree. Yep, looks like it's dead.
Well, and I think that probably answers a lot of the questions that we're seeing coming in through the chat, and probably puts a lot of people's minds at ease too. I mean, and that's this fact and fiction thing, right? Like, yes, that can create a lot of fear, but in many ways, if something's not reasonable, it's not going to get passed. So I know we're getting down to our last couple of minutes, but I do want to ask you and get your thoughts on the Senate Finance Committee proposals. So Chairman Wyden and his colleagues have released a number of proposals, and you mentioned some of them as we've been talking this afternoon, but they've released these proposals over the last several months, closing loopholes in some of the partnership taxation rules, and that could become part of the budget reconciliation process as well. So Chris, what do we need to be looking out for at a super high level there, and just be aware of as we're reading through everything and following along from home?
As you know, Jen, partnership taxation is probably the most complex entity taxation that we deal with because they're so flexible. And with flexibility comes complexity. Well, what Senator Wyden is proposing is first, getting mandatory adjustments upon a death or a transfer of a partnership interest. We have what's called Section 754, a little bit wonky, but it's an election that's made that allows us to adjust the basis of underlying assets for the share of the assets of the decedent or the share of the assets purchased by a purchaser. This would be mandatory. Another one would be making partnership allocations in accordance with the partner's interest in the partnership. As I said, partnerships are very flexible. I can design a partnership that says, well, you're providing labor and management, this is your reward, you're providing capital, maybe it's a preferred interest that you have, preferred allocation, you're doing other work for the partnership with special expertise, this is your reward. The proposals from Senator Wyden would say, no, all of these allocations should be in accordance with the percentage interest in the partnership. Just a couple of others, elimination of guaranteed payments. Not sure how that would play out. Maybe the guaranteed payments would be replaced by W-2 wages to a partner, which would be something that technically isn't allowed today. I know a lot of partnerships do it, but the IRS, when they audit, they say, no, you can't do this. The business interest expense, difference between the House and the Senate approach on the limitation of the deductibility of business interest expense. Probably the most extreme on the Senate side is the Senate would say contributions to a partnership and distributions from a partnership would be taxable outside of the family partnership. I think they draw an exception for family partnerships, but they would be taxable. And that is a radical change in partnership taxation if they adopted that.
Yeah, absolutely. And Chris, we're coming up on time, but I want to ask you one more thing, just kind of from the heart, and really more from an advisory perspective. You know, we've unpacked a lot here today, and I know we'll continue doing that in future sessions. We didn't even touch on the SALT deduction changes, but rather than dive into some of the technical, what advice could you give those of us at home just about how to digest all this information while the proposals are in process, and some key things we need to be considering as we approach our tax planning?
Moving targets and uncertainty. It's been said that even bad tax laws aren't as bad as uncertain tax laws. Give me a set of laws that that are permanent, or I know what the law is and I can work with it. And this whole process just creates so much uncertainty that I don't know what to do. I don't know if the decisions that I make today, just like what we talked about on Section 1202, I thought I was going to get a 100% capital gain exclusion, and yet if this goes through, I won't. And is that going to stop people from might change their dynamic, their decision tree as to whether they invest in a new tech company, for example? Now, you ask, well, what can you do? Well, I think be prepared. First of all, if we do have time, and this is not going to be something that is passed and enacted within a 2-week period of time here. It may be in December. It may be in January or February before the parties and the House and the Senate and the president all finally get a package that they can agree on, if they can get a package they agree on. And for high wealth clients, have your estate plan ready to go to be pivoting on a dime if you need to, especially with December 31 approaching. As we get closer to December 31, you have some decisions to make. Those people with outstanding installment sales, you may consider to dispose of the installment sale contract, capture the maximum 20% capital gain rate today, because next year collection on that same installment sale may be at 28.8% from a federal viewpoint. So are just a couple of suggestions. It's really hard to provide advice because so many of these proposals also have dates that are now in the past, September 13th. And probably too late. I don't see them moving those effective dates on capital gains to some later date. That's probably baked in at this point. If they are successful in enacting legislation, my guess is that it will have an effective date for capital gain transactions September 13th.
Absolutely. Well, Chris, this is such a great session. And as you know, I am such a fangirl of yours. I have been since I joined CLA, and I just truly value your insight and the time you take to clarify what are some really complex matters and make them understandable and translatable into our business decisions and our daily decisions about what we're going to do. So thank you so much for being here and getting the conversation started. I know we're going to have more from you and our National Tax Office as everything becomes final, and we can dive more deeply into the specifics in future sessions here. So just thank you so much for being here with me today. Thank you as well to our audience, our moderators in the chat, and to the whole programming team for the live stream and the other great learning sessions that we have available. We look forward to seeing everybody in the coming weeks, and until then, have a great weekend, everybody.
Thanks.